In a matter of 14 days, markets reversed its gains from the levels of 18K mark. It plunged to 17K. Therefore, as markets go through ups and downs, how should equity investors manage their portfolio to yield maximum benefit despite the sharp volatility? Now, is it the right time to average out your investments? To discuss this and how should you position yourself in the market, we welcome on board author of financial management books and president and CFO of Grasim Industries, Shanti Dugar. Shanti, good evening and welcome to the show. Let's analyze how an investment portfolio should be rebalanced or reworked on, considering the kind of the market environment we are witnessing. So, first come first, I want to understand, do you think or is it the right time for a long-term investor to average out their profits or maybe come out of a particular investment if it's been underperforming?
Thanks, Kavita, for bringing me on your show. First of all, for long-term investors, it is always the right time to invest in the equity market. Of course, the people who invest at the bottom or correction of the market, they tend to earn a higher return than the people who invest at the peak. And statistics shows that if you have invested at the average of the year index, then your chances of the getting higher returns is almost 28-29% CAGR for last 16 years data if you collect. But if you have invested at the peak of the year index, then that average return comes down to almost like 14-15%. So the key is to enter into the market when there is a real opportunity and when there is a adequate margin of safety in the market. Till that time, a long-term investor should wait infinitely if he has to wait.
What is actually a real opportunity if one wants to really quantify this in terms of time horizon and the right time to entry? Do we really have that kind of a right time to enter into the market?
So right time, I would say that for a rational investor, for a smart investor, you have to first determine your objectives and goals, why you want to invest into the stock market and what returns you expect from your portfolio. Then only you can take the right decision. Unless you do that, like if you just start investing in the dark without setting out your goals and horizon for which you want to invest long term, medium term, and short term, you may go wrong. And then you have to choose the segment in which you want to invest. And to choose the segment, you have to do proper study of that industry segment, where the growth is likely to happen in future, which are the industry which are in already matured in their product life cycle, and which are the sunrise industries. So that balancing, that study is very, very important. And plus, one more important thing is that you need to gauge your risk appetite, how much risk you can afford to take, and then create a risk index matrix that at what level of market you will invest how much. And that metric should be created considering your affordability to invest and how much you want to cash in when there is a opportunity to make profit. So that is very critical. Once you have done these basic things, 3-4 things, then the next step is to identify the right stocks in the market, because unless you select the right stocks, you may go wrong. And history suggests us that out of 8,000 almost listed companies in India, only 500 companies, which is less than 5% of the companies have given positive returns to the investors in the last 15-20 years. And within those 500 companies, only 2% of the companies have given like 20% plus returns to the investors. So though it looks very attractive to say that stock market is very easy to make money in the stock market, but you need to play it smartly. Then only it's a very very wide platform to make money. Otherwise, it can go the different way what you think. So there are some do's and don'ts for the right investor. In do's, I would say select your, determine your objectives, determine your goals for what you are investing, long term, medium term, short term, how much money you would like to invest at what level of market. Then choose the industry segment correctly after thorough due diligence, which is the rising industry, which is the dying industry. Then out of those selected industry segment, choose the right stocks after doing thorough fundamental and technical analysis. And I can discuss in detail how to do the fundamental analysis, technical analysis in some different show. But for the timing, I think these are very important. And then there are few do nots, like you should not do into the market to
So,
get
Shanti,
your.
before I get on to the don'ts, I want you to help the investors in picking up the right company, because a lot of research goes over there. So, what kind of companies should one be picking up in terms of investment, in terms of stocks? And which are the companies, if at all you have them in your portfolio, and if there is a red flag, how would you define a red flag of a company which is in your portfolio, and you should be really taking that, striking that particular investment out of your portfolio?
So I will put the answer into two parts,
Sure.
Kavita. First part is how do you pick up the stocks? For that, I would suggest you do a complete analysis on your own, equity research and analysis, what we call it. You should do on your own. If you just rely on your broker's tips or hearsay or somebody else advice, you may not be the wise investor, I would say. So first and foremost is do your own analysis, own research. Do not follow others' advice or brokers' advice or hearsay comments. And then look for some fundamental factors like companies' PE multiple, debt EBITDA level, leveraging ratios, solvency ratios, book price to book value, and then some technical factors like how much percentage it has already gone up from the average level or from the bottom level, and how much lower it is from the peak level achieved in last 5 years, 10 years, 15 years. And then you classify those companies into red bracket, yellow bracket, green zone, and which are the companies falling in the green zone, you should invest in that. That's number one. Number two, in the current market scenario, I think when interest rates are rising and commodity prices are falling, you should avoid those companies which have high leverages, number one, because their debt interest cost is going to go up significantly, and avoid those companies which have high import content in their revenue mix or cost mix, because if they are not able to pass on to their customers, they may go, their profitability may go for a very, very severe hit in coming days. So go for low leverage companies and the companies which have high export revenue and low import content, I would suggest.
In the current scenario, which are the sectors that you are trying to analyze based on the kind of pointers you've just mentioned in terms of company selections also? Which specific sectors you think one can be invested in, or maybe if they want to put in some money for a time horizon of maybe medium to long term, what is your outlook like?
So my preferred sector would be infrastructure-led sectors like cement, steel, transportation, because government is putting a lot of focus and investment in the infra projects, roads, rails, ports, power plants, bullet trains. So this is going to give a very, very big boost to the cement and steel demand in times to come. Plus, the recently announced national logistic policy by the government is a very, very big step towards optimizing the logistics cost in India. So I would invest in those fundamentally infrastructure sector and traditional sectors rather than investing in those startups or new age sector in the current market environment.
Shanti, let's go back to the don'ts that you were just talking about. So, which are the don'ts in your investment journey, and especially considering the current market volatility and the outlook, and considering the international scenario, which are the don'ts that you should accept and work on?
So my first don'ts will be don't do leveraging, like don't borrow money and invest in the stock market. If you have surplus money of your own, then only you should invest. If you leverage out yourself, then you may go even bankrupt. Second don'ts will be don't over diversify, because if you over diversify, you can suffocate your portfolio. your return will be minuscule, but you will not be able to make a large money when the market goes in your favor. So ideally, there should be only 10 or 11 stocks in your portfolio, and whichever stocks you select should be selected based on the thorough analysis, as I said earlier, after fundamental factors and technical factors, putting them into green zone, yellow zone, and red zone. And whichever stocks you have selected, put some good amount of money in that. Then don't be miser to put a very little money, because if you put a very little money, you will make a very little return. That will not make you happy. The third don't is never short sell in the market. If you start short selling, it will can kill you like anything when the market goes up. And fourth is don't wait to buy at the lowest and sell at the highest. That opportunity never comes. If you have that thinking that I will always sell at the highest peak and always buy at the lowest, I think you are living in a utopia. You may not achieve that scenario. So enter when the investment meets your criteria.
Got it.
Yeah.
All right. So these are the do's and don'ts, and also the right time to average out your investment if at all it's not performing well in the current scenario. Thank you so much, Shanti, for making time and helping our investor, guiding them for their on their financial portfolio. Thank you so much.
Thank you, Kavita. Thanks a lot.